Welcome, everyone, to our latest edition of Real Talk, where we put the real in real estate. We've got Gregg Webb here, secondary marketing manager of AmCap Home Loans. That is big title there, Gregg. Thanks for joining us today.
Well, I'm glad you're having me. Thank you so much.
Now, what is a secondary marketing manager for those of us that don't know what that is?
So we sell all of our loans that we pull together on the secondary market. So maybe that's selling it directly to Fannie or Freddie or to an aggregator like Penny Mac or Mr. Cooper. We also sell it directly to Ginnie Mae. And that's what the secondary market mostly is. It's going to be on the back end of it. After your loan closes, we group them up together and we sell them in bulk to different places where we can try to make the most yield out of them.
Awesome. Okay. Well, we had you on today because I don't know if everybody who's watching realizes that the topic of interest, no pun intended, has been interest rates here lately in the real estate world. And it seems like we just can't catch a break. The last couple of years have been a roller coaster ride like none other in the real estate business. So now let's add in the wild card of interest rates going higher than we've seen quite some time. Sharing a stat with you, I think it's like over half of our licensees in the state of Texas have been licensed for less than 5 years. So when you talk about that and interest rates have been where they are for the past several years, kind of gives you a perspective from the realtor side that there's just a lot of realtors that don't remember interest rates that are really above 3.5%.
Yeah, I believe the last time we've actually had rates this high was in 2007. So we just got out of recession. 2007 is when they started peaking around 6.25. Then we had the Great Recession, and then that's when everything came down. And we've been in, growth mode ever since then. And rates have been so low, then good old COVID happened, and they started doing QE again, and we had those unbelievable rates the past 2 years. So.
Yeah. Well, and that's an important thing. I mean, let's talk about, we're going to do nerd talk for just a little bit, and then we're going to put you on the spot and talk about the things that we really want to know. Why does that happen? Okay. So you just talked about, 2007 when the market was crashing. People are wanting to liken a lot of the trajectory that we're on right now to that period of time. And again, most of our realtors were not licensed at that time. So they have a very different perspective, whether it's being as a consumer or just somebody of the layman public. They weren't there to see the nuances behind the scenes. And so 2007, rates peaked, and then all of a sudden we have the Great Recession, and they bottom out to almost free money, which is where we've basically been ever since. So what does that mean for us right now if we're using that historical trending data?
Well, I think that just like anything else, you hit the top of anything, then you start readjusting, and then you start hitting bottoms and tops. So just like in real estate, what a lot of people have seen is that if the average is in 5 years, you probably haven't seen that. You've only seen it keep on going up. But at one point, it'll bottom down. You'll see an adjustment. The good thing about we're in Texas, so you might see only a 10 to 15% adjustment at the most. And that was during the Great Recession. I mean, in some areas, maybe they did 30%, but that was very, very little, and that was mostly on the larger homes and stuff like that.
And you're talking about pricing. So
yes,
the pricing,
yes.
we only saw, and I think that's so hard because everybody's like this. It was a horrific market crash in so many ways. The financial industry, it was a real estate caused, recession in so many ways, and that's obviously a very surface level way to say that. But yeah, in Texas, we saw on average only about a 10% to 15% drop in property values, where, like you were saying, other areas of the country were 30, 40, 50%.
Yeah, I mean, some places in Arizona and Nevada and even California, you saw it drop almost to 60%. I mean, they had places in Nevada and Arizona where they had blocks of brand new homes and stuff that people just moved into that were all in foreclosure. I mean, the same thing in Florida. I mean, but you had those crazy products that back then that we don't have anymore. You had the pay option arms where pretty much it's a negative amortization. So, you bought a house for $100,000 in 5 years, you owe $150,000 and the house is not even close to what it's worth. So you had products like that. Then you had the Fast and Easy that Countrywide did, and the pay option arms where you could pretty much just lie about stuff. Then good old Wachovia did the 80-20 stated non-owners. I mean, they just had all those crazy crazy products and stuff. And then the worst part about it, I'm not sure if anybody saw the Big Short, but even in what and all that, that's what was happening. People were going around and packaging these subprime loans and put them in paper bonds, and because everybody was chasing money, everybody thought there's no way we're ever going to go around and something's going to happen to our market. So poor Iceland, and I think it was Iceland, they had all of their whole pension fund for the government that was in those bonds and stuff like that, and they pretty much, a lot of people couldn't retire because didn't have any money in it. So, but that's a good thing about some of the good things about the Frank Dodd stuff. There's a lot of bad things about Frank Dodd, but at the same time, that helped out too about the Frank Dodd, where it limited where you don't have to worry about those crazy things and doing the swaps and all that stuff that we have.
So Greg, what I've figured out is you are a mortgage nerd. And I appreciate that, because that means you know what you're talking about, because there's a lot of things that you're dropping right now that are even kind of going over my head. But I happen to have a go-to source and maybe a really tall family member who just so happens to have been or still is, not been. You're not a Ben, Chad. But I have met you through Chad Fearbacher, who is one of your loan officers at AmCap. It's a privilege. He's my stepdad. So he wears many hats. He keeps us in line. He's married to my mother, and that's another job in itself. But a lot of people don't know. I actually got my start there she is. She pops in. Hi, Greg.
Hi.
So I got my start in the real estate business actually as Chad's loan processor. And so I got to see him working on the front lines, and gosh, that was 20 years ago.
Oh, I thought you were the receptionist for a little while during the summertime when you were like 16 or 17 years old and stuff, and all that stuff.
Yeah, that was that time. So I just kind of I wore all hats, but that
was 4 or 5 years ago, right?
It was 4 or 5 years ago. Flattery will get you everywhere, Greg. So, but yeah, it's been about 20 years, and I got to watch Chad during that time where there was a lot of predatory lending, like you were just talking about.
Yeah.
The stated income loans, you had predatory marketing from builders who were basically saying 0%, $500 to get in this 3,000 square foot box of a home. And then once the people were leveraged up to their eyeballs, they couldn't afford furniture or the utilities. And so it wasn't just about the decrease in the pricing. It was also the fact that most people were buying way out of their capacity to begin with.
Well, we had this one lady, we had a loan officer that I dealt with for a long time. He had this one lady that he was trying to help. The broker that she went to the first time put her in a subprime loan, and she could have done FHA all day long, and her rate at that time would have been around 5.25. Well, they put her in the subprime because they could get paid more, and kept her at 9%. And by the time how everything worked and how they set the whole loan up, she was in a negative AM, so she couldn't even refi out of it. So she had to let the home go. And it's not that she lost her job or anything else, is that she just got to a point where her rate kept on adjusting so much where she couldn't afford the payment anymore. And there was no way for her to get out of it because the guy was trying to make more money. And like I said, that's one thing that's nice about the Frank Dodd. I can go on and on about all the bad things about it, but there's a couple of things that was nice about it. And that's one thing that's trying to protect the consumer on that altogether. So.
Well, and that's the whole thing. And I think this goes back to not all realtors are doing right by their clients and advocating appropriately. And the same thing was going for loan officers. It's about the almighty dollar. And that's really disconcerting. Like Patricia Garza said, not to mention loan officers were encouraging buyers to roll in all costs, including furniture, pool, et cetera. Who wants to pay for furniture for 30 years? There was some wacky stuff going on there for a while. It was just the wild, wild west. And yeah, it was. And so being, I was there on that side, even on the loan side. And I watched Chad literally say, I know so-and-so down the street will do it, but I won't. You guys need to wait another 6 months to a year, save up a little bit more money. I remember somebody literally saying, well, if we cut out Dr. Pepper from our budget, Dr. Pepper. And I know Texans love their Dr. Pepper, Greg, but somebody said, well, if we cut out Dr. Pepper, if you are that tight that you have to cut out soda consumption to afford your home, it's probably not a good idea. And Chad did. I mean, that's why I admired about him working with him at that time. And that was before he became a family member. And I just immense respect for people that handled themselves at that point. And so there was a lot that didn't. And the same thing goes with realtors. I mean, we could have done a better job to advocate for our clients and educate them as to why some of these predatory tactics weren't a good idea. But we are in a new world. And I think, but everybody's kind of got a little bit of not amnesia, but they want to revert back to 2005, 2006, what was going on. Then we having 2007, the crash, everything else. And that's not where we are right now. So talk a little bit about that for me, if you don't mind. That was kind of a real estate induced housing.
So you're talking about the difference from like 2007 and what I'm currently dealing with right now?
Correct.
So mostly on the 2007 stuff, I mean, it goes back to the swaps and all that stuff. And they're throwing bad loans into AAA bond loans, ratings and stuff like that. And that's what happened. So when they started defaulting on those, that AAA started going around and go bad. And that's what really affected the whole mortgage market, because we had to go around and rethink everything on the secondary side of it, how we're doing swaps, all that stuff. And put rules in place so we wouldn't be back in the same situation. Now, pretty much you have non-QM right now that's going on.
What is non-QM for some people out there?
QM loan is going to be your Fannie, Freddie, Ginnie, stuff like that. So they have different kind of tests that you have to go behind it for your high cost and all that stuff. So fee testing, all that stuff has to go into that loan to make sure that it stays in this little box, right here. So when they're going around and put it into, coupons and the swaps and all that stuff, it stays in that AAA bond rating and stuff like that. Your non-QM are going to be more of your high risk loans and stuff. People that are self-employed that, they're writing off every little bit they can. So really they're saying they're only making like $15,000 a year for tax benefits, but in reality, the living off of, they're really making about 150 to 200,000. And that's what those stated loans were really meant for. But the problem was they were doing it for everybody, even a W-2 borrower. So, you work at Cisco or, somewhere like that, you get your salary is $125,000 every single year. You get your year raise and all that stuff. You're W-2. Exactly. Well, these people are going around and saying, well, they're stating their income at $350,000 so they can buy this huge house. Well, they really couldn't afford it. Just like you said, I mean, you're taking Dr. Pepper out and spending, $200 to get your payment where you need to be at, and they have an empty house because they can't afford furniture. I mean, they can't afford anything. They can barely afford the electric bill. So all that stuff, that's the difference from the subprime and non-QM right now. So on the non-QM, what they're usually mostly doing, except on the investment property stuff where you can go around and do maybe 10% down, pretty much all that stuff is going to be by LTV, so your loan to value. So if your house appraises for $100,000, just to make quick, easy math, you usually have to put 20% down or more, the riskier the loan is. So, and that's how they're doing stuff now, so we can try to protect ourselves a little bit better. So, and that's the reason why on those non-QM loans, you're looking at a rate of 7.25%, 8%, and all that good stuff.
Yeah, it's mitigated risk. And I think that's what people have to understand. And so right now, people are just talking Chicken Little, the sky's falling again, Greg. Oh my gosh, we're going to go into the Great Recession and housing crash. So a recession and the Great Recession housing crash, I think, need to be separated, because we're hearing a lot of talk about the inflation is going to cause us to go into a recession. Mm-hmm. Do you agree with that?
Yeah, I do. And the reason why is this right here is that when inflation keeps on going, the cost of goods are going to go up. So if you're a family that usually spends $300 or $400 a month on groceries and stuff, and it goes up to $500, that extra $100 for most people are going to go around and be a huge effect for somebody. And because of that, what they're going to start doing is they're going to start backing off of how much you're spending. So recessions are good to a certain extent and bad at the same time. So I'm not sure if y'all know what the difference from a depression and a recession is. I had an economics doctor told me one time, says, if you have a recession, that means that you have a job, but your next door neighbor doesn't have a job. And on a depression, both of y'all are out of work. So in saying that, I think that the recession that we have, especially being in Texas and stuff, and I mean, I love and hate oil. So I think that it's a great thing for Texas. And I think that us drilling and all that stuff creates so many jobs, and that's so great for us, especially in the small communities and everything like that. And because of that, I think the recession won't really hurt us that much because everybody likes to drive their vehicles. So I mean, unless you live in
Well,
little,
Greg, I don't know if you're aware right now, but we're about at $5 a gas. So we might need to curb that enthusiasm about driving just
well,
a little bit.
well, I understand that, but it's just like anything else. You curve it, and eventually it's just the same thing that happened in '09. I mean, we had oil at that time was $150 a barrel. So you went around, and I think when I just looked at it today, I think it was 115 when I was watching the news this morning. So that was the only difference and stuff from right now. So, but people are going to pay for your gas. I mean, my point
No,
is,
you're absolutely, listen, you're absolutely right. You're gonna pay for gas, but maybe you don't spend somewhere else. And I think
exactly.
that's what we're seeing right now. And then you and I kind of talked about this a little bit, and it's not something that obviously you guys hear in your water cooler talk as loan officers as much, but being in the community, dealing with relocation clients and dealing with people that are moving to Texas, a lot of the things that I'm hearing about why people are choosing Texas, it's not political, it's economical. It's opportunity. And so just beyond the oil, the advancement and the employment opportunities with the different corporations that are now headquartering here. And like you said, we've always had more Fortune 500 companies than other places around the country. But it's happening even more in the last few years that we've seen people uproot because of the affordability, because of the drivability. We just have so many things. Do you know that per capita, I think we have more restaurants in certain areas in North Texas than they do even in California? I mean, people don't realize how lucky we are here. Our arts and entertainment district with our theaters and our museums, we have more in that district in Dallas than just about any other area in the country as well. And so it's not just about one thing. We all multicultural. We have become a national melting pot. People aren't just lifelong Texans, as my husband reminds me of, because I got here in '96, which we tried fast enough, but it's still not good enough. So at least my daughter's a native Texan. And so I'll piggyback off of that. But I think it's one of those things where we have to put things into perspective. And from a national scope, yeah, the world's a little scary, and just from the financial side. But a hyper local focus, specifically on North Texas, I can tell you our infrastructure is something that people notate all the time, our road network system, our drivability to different towns, the fact that, yeah, if you want to live really close to everything going on, maybe you're going to be paying a premium, but you also have an ability to drive a little bit further out, save on taxes, save on the average price per home. There are options. What you were talking about is that we're seeing a shift in the remote workforce. There's a lot of people that decided to even move out of the country because they could work remotely. Who did you mention? There was some.
Elon Musk.
There you
Elon
go.
Musk. He had a programmer that moved to Costa Rica, and pretty much he's trying to move everybody to start working and stuff back. So, and that's the one thing that he was looking at. So, because I mean, those people that have to go around, he has to hire one person for HR to handle all their needs. It's just not really worth it or economical for that situation.
So I think it's looking at all of those things. Things are trending back to in-person work, different things like that. And so that's also going to be a changing life. We've just had to pivot a lot. I used to love that word because I was a real fan of Friends. And I don't know if you've ever had to move furniture, Greg. But yeah, once or twice. But every time Sherry and I have to move a piece of furniture, one of us is going to start laughing and screaming pivot at the other one. But I feel like we've been doing that for the last 2 years on an audio loop at this point. And so now maybe we are getting back to some traditionalism just a little bit. Yes, I know, pivot, Ross. Yes, that's exactly what we're doing. But I think using things, if we go back to 2007 and 2008 and compare that to where we are in 2022. It's a major disadvantage, not only because the housing market looks very different, the economy looks very different, how we're protecting certain aspects of that looks different. But the world has been different the past 2 years, so we can't compare it to anything.
Well, we also have growth that we've never had before either, too. So we're still growing. I mean, even with the inflation, with everything starting to slow down and stuff. I mean, just recently, the major banks went around and put a hiring freeze on everything. I mean, I'm not sure if y'all ever go to Wells Fargo or Chase or even Bank of America. They
Yes.
have no tellers there at all now because they can't hire people. People are quitting. I mean, you got the Great Recession that happened last year, and that was one of the things that even they put a hiring freeze on all that stuff. They still don't have enough people to go around if you want to get your cash out of your bank.
So I think you were talking about the Great Resignation.
Sorry.
Yes, there you go. Yeah, no, but you're absolutely right, and that's happening on all fronts. We were talking about it from the association side because we have nearly 26,000 members in MetroTex. We are the 5th largest local association in the country. You know, we have local, state, and national, and so we're local. You know, being in the DFW area. And just talking about, I mean, we've got a robust staff. We have, you know, affiliate members, you know, realtor members, all these other things. Everybody is talking just about what it looks like in their own backyard to hire and retain talent. And I think that's something that's changing, and some for the good. We're reshaping how we're looking at these things. But I think that's the difference. When you said that the recession is you have a job and your neighbor doesn't, when we have so many job vacancies, seems like maybe that can be mitigated just a little bit more.
And I agree. I mean, just for example, I mean, the real estate, there's a local lender that we have that's here that they laid off 25% of their workforce. I mean, Better Mortgage, I mean, I think they laid off 40% of the workforce across the nation. I mean, and those jobs are getting filled because they can go find a job that's decent paying. I mean, for example, the Amazon stuff. I mean, there's a lot of other things that people can go do if they want to get out of the industry and all that stuff. So there's some good and bads to it, but at the same time, you can still find something instead of worrying about not having a job and just sitting in unemployment for 6 months at a time. So
yeah, no, and I agree with that. So we won't go on the unemployment soapbox because I bet you we could do that just for a little bit as well. Instead, let's circle it back to what's been going on in this crazy real estate market. And so for me and where I sit, you know, I've been, you know, I work by referral only. So I don't have one central geographic area, one price point. I work with first-time home buyers. I work with investors. I work with luxury buyers. We do build jobs. We do, you know, resales. So it's been across the board. And what I can tell you is, you know, there's a lot of scary things that are obviously happening for the average consumer, even the average seller. I mean, everybody thinks, you know, it's great to be a seller right now, but most of them turn into buyers. And so it has been unnerving. You know, there's a premium tag to housing at this point, because what we did find going through, you know, the 2020 season and everything else was that the one thing that everybody still needed was shelter. And then how valuable and important that was. And I think people started to understand what was important to them. There's a lot of bad things that came from all of the pivoting, as we'll say, put in positive spin, from that year. But what did happen is it made people realize what they truly valued. And so maybe that was moving closer to family. Maybe that was moving family closer to them. Remote work, and now all of a sudden you're
in a bigger house because you're working from home, stuff like that. Yeah,
you need 2 offices and a homeschool room.
Exactly.
You know, and so there were so many things that I think now that reshapes the natural characteristic and how buyers are approaching that home purchasing process. And so when you look at it that way, it's hard. I think it's, hey, look at cars right now. You're having to pay over sticker for a car because we have a chip shortage and, you know, our importing shortage on other parts and things like that. So I think what we have to think about, we're shining the light on homes because it is the largest product, you know, financially, but it's across the board that we're seeing this inflation and this premium spending on these type of products. What I will say is, I'm having better conversations with my clients when they call and say, "Hey, Ashley, am I insane? I want to enter into the wild, wild west of home purchasing right now. I'm a first time home buyer." I'm like, how exciting is that? Yeah, it's a little scary right now, but let's talk about your motives. I think it's getting back down to your motives. Like Patricia was saying, I'm seeing families move in together, a multi-generational situation. Maybe there's a young, a young couple or something that wants to buy a home for the first time because they want to move their parents in, and help them offset some of the increased living expenses. So there's a lot of different things, but I think we need to ask better qualifier questions, because if somebody says, I want a good deal and I just want to invest my money into real estate right now, and that's what I want to do, I'm going to have a different conversation than somebody that says, hey, I need to be closer to my work, closer to my family. My home's too small. I work from home now. It's impeding on my family's, everyday lifestyle and the health and wellness of that. Okay, then I'm going to redirect you back to that time and time again when we're going through this arduous process. But it's always figuring out what those pressure points are. And I think we're not doing a good enough job to figure out why people are needing to purchase their homes right now. And if we do that, then we can reshape a conversation. And then that's also teeing up you guys for success, Greg, because I think that's the hard part. Go ahead.
I think that, just like you said before, that's the reason why you have to find a good loan officer.
Yeah,
a good loan officer is going to go around and sit down with you, pull your credit, look at your situation, have a conversation with you and say, hey, look, right now, this is the only amount that you can really buy. If you go around and go something this right here, you're not going to have any quality of living at all. And that's another thing people are thinking about too, is after being stuck in your house for 2 years, you want to have somewhat of a quality of living to go do things, enjoy yourself and all that stuff. And you can't do that if you're maxed out at the very, your house board. That's pretty much what it is.
Yeah.
And that's where we have to figure that out. But the nice thing about it is what they just said today, all the commodity pricing for building a house, your copper's gone down quite a bit, lumber's gone down, all those commodities pretty much, except for unless you have a chip or something like that, those commodities are starting to come down. So the inflationary period that we're looking at are starting to help out quite a bit. The only thing that really worries me the most is the fertilizer was quite a bit more this year for the growing season, and the diesel was more for your tractors and everything. And that's the other problem that we have too. We don't have enough refineries. They're pumping enough oil out. We just don't have enough refineries in there. And the crazy thing about it, in about 07, I think it was 07 or 06, is when we actually started shutting down refineries across the nation. And because we don't have enough refineries to go around and take care of all the oil production that we have, that's another thing, that reason why gas prices are as high as they are right now.
So you're saying, I guess we did this to ourselves. It's a self-fulfilling prophecy, and maybe that we need to get out there and vote just a little bit more. But I'm going to go on a different tangent just for a second, because Sherry did chime in and say, what are your 2, 5, 10-year goals? And I think that's different right now too, because like you and I were talking about, interest rates are higher than we've seen in 15 years. And so that's something that's a little different. We have to reshape our thought process when we're looking at that. So can you afford these higher interest rates right now? Do we think those are going to dip back down? You and I talked about having a conversation of, look, don't have a crystal ball and can't guarantee anything, but there is an opportunity, should rates dip back down, that you can refinance in a couple of years. Isn't that correct?
Yeah, that's exactly right. That's the whole thing about it. We go through cycles. Everything goes through cycles, however you want to look at it. So just in any cycle and everything else, you're going to hit the high, then we're going to go back to the low and stuff like that. So we might never see 2.25 in our lifetime, but there's a good chance that you're going to see your 3.5s, your low 4s and stuff like that again pretty soon. And if you're really talking about rates, let's say that your rate right now is at 6.25. And I'm looking at a chart I have right here. In April of 1982, it was 16.89 was the average rate, and you had to pay 2.2 in discount. So when I'm talking about your 6.25, that's usually going to be your par rate. So that's not paying any discount at all. Now, and there's some people that want to go around and pay for the discount, but at the same time, if you pay that extra money right now, there's a good chance in the future where that if you refi, you just wasted a bunch of money, because in 2 or 3 years, you should be able to refi and get a lower rate and use that money towards your lower rate if you want to.
Well, and I think that's a great point. That goes back to Sherry's 2, 5, 10 years. If you're only going to be in that house for a couple of years, let's
Mhm.
reshape the conversation how we're looking at these things, buying down your rate, discount points, things of that nature. If you're going to be there 10 years, hedge your bets a little bit. Maybe there's some different things that we can talk about doing, and let's look at that from different vantage points. And I think when you're talking about order takers, or online loan platforms. And I'm not trying to demonize anybody for being predatory. It's not about being predatory, but there is an advisory and an advocacy piece that we strip away from the real estate industry. And that's for the loan industry, and that's for the real estate services industry. And we have to get back to talking about, yeah, it's great that you can streamline the application process. Streamlining the application process is not streamlining the loan process to where you never talk to an individual and actually get proper advisement. And we swung the pendulum too far with these online platforms. But it's also because we stripped our value proposition away on both sides of the aisle for us. I think lenders were obviously deemed predatory for a while. Unfortunately, the bad made
Yeah.
the good look really bad too. It's the same thing for realtors. We were talking about it today in a meeting, was the fact that we have all these online platforms, these iBuyers, these instant buyer programs. It's because we forgot what our value proposition is. We resigned ourselves to being showing agents because we had the data and we had the keys. Now we don't have the data to ourselves. And in some sense, there's self-showing, services. We don't even have the keys. So when you're sitting there and doing that, we have to understand really what we do for the consumer public. And that's, we give them advice, we advocate on their behalf, we give them options. So, okay. Rehash Design Real Estate Group. There's not anything suggesting that rates will get to the 8, 10, 12% area, is there?
Nothing that I have seen.
Okay.
But I mean, it's just like anything else. You could have a perfect storm and it could get to maybe the 8%. I don't ever see it getting to double digits again anywhere. I mean, unless you start going into those non-QM loans I was talking about.
Sure.
But that's about it. But everything's in reality. I mean, relativity. I mean, everybody thinks that the rates that we have right now are high. Your parents and stuff starts. I mean, my dad used to laugh at me when I would say, back especially in 07, when I told him about 6%. He's like, he started laughing. He says, "Well, you forget that when we bought our first house, we had to pay, I think it was 15% for 30 years, and I had to pay 3 points for it." And he was laughing about it. And now at 6.25%, that's like a home run for me. So, and it's just like what you said earlier. I mean, everybody's talking about the rates on your mortgage, but look at your credit card bill. I mean, if you have a outstanding balance and you're paying at 28%, or even if you have perfect credit and you're paying 15%, I mean, that's still 2 to 3 times more than what you're paying right now for a mortgage. So,
well, and I think that's all relative. Again, we figured out that housing was the most important thing to all of us very recently. And when you're looking at that from that standpoint, okay, if it's the most important thing, look at it through a different lens. How many streaming services do you have? How much do you go out to eat and do entertainment? I always liken it to this because I'm a type A person and I don't like to travel. So like traveling to me is like a 48-hour trip. So that sounds delightful. So I know I'm not looking at it from the right lens again, but there's so many people that will drop $10, $15, $20,000 on a luxury vacation or a family vacation, where half the people are screaming, they're crying. Maybe you get 2 Instagram worthy family, pics that you can post to at least get your money's worth. And then you know what? You come home to your house. And so if you're willing to spend that, but now you're arguing with me over $2,000 on your home, let's talk about this a little differently. And I think that's where the education piece goes into it, Greg. Before you even start looking at houses, we need to start having these conversations with our clients, not only as the realtor, but with your lender partner as well. And that's why you need to hitch your wagon to somebody that's your teammate, not somebody.
Exactly.
When somebody says, well, I might shop around and look for a lower rate, then you need to go find another realtor. And that's something,
or a partner. And that's what AmCap's thing is a true partner. And that's how we look at it. I mean, for example, Chad, he will go around and do whatever he can to go around and make sure that he's getting the best deal and trying to help that borrower out to go around and get things going for them. So I mean, that's the whole thing about it. I think that's the hugest thing. You're making your largest purchase. Are you just going to go around and go online and say, oh, Redfin, go ahead and buy my house? Well, who's helping you with that process? I mean, you have somebody that's not even looking at the house. They're seeing pictures. They have no idea what they're looking at. As a good realtor, you're looking at the foundation. You're making sure that the plumbing's decent. I mean, you're turning the water faucets on and making sure that everything works. I mean, that's what a good realtor does, and that's what y'all offer. And the same thing with a good loan officer. A good loan officer is going to go around and make sure that that client is getting taken care of. And I think that's where a lot of people forget about that. I mean, because anybody can go to Quicken and get a loan, but you're going to have somebody that's just going around and just pressing a bunch of buttons and stuff like that, instead of somebody really looking at everything and figuring out the best solution for you. So
I will tell you, I put myself on mute, but I pointed my finger and set my dogs to their kennels, and it worked. So that I should go buy a lottery ticket, because I wasn't expecting it to work that way. But I will say one thing, because my broker of record is on this. What we do is we point out deficiencies in the home that a licensed professional in that trade will further inspect, right, Sherry? So I am not a foundation expert, but I should at least alert my client when they should enlist the help of one. So that's that one disclaimer there, Greg. But those are the things we say, hey, you know what? This isn't what I do best. Same thing back to the financial piece. Hey, I don't think you're in with the right relationship there. I need you to talk to my trusted partner, if nothing else, to get a second opinion. But what I will tell you, when you come from a place of trust and respect, when you work by referral, it's very easy to reshape the conversations that way. I understand you guys think that by going online, you're getting the cheapest loan possible. But right now in this housing market, as a listing agent specifically, I work with buyers and sellers. But as a listing agent, when I get offers, I'm making a spreadsheet. And that spreadsheet has different columns. And it's talking about the financing, it's talking about the cash down, option period, financing period, different notations about how the contract is filled out. Was there any communication from the realtor that's sending me the offer? Was it properly filled out? Was there any inflammatory language in the communication that I had with the realtor? And you know what? The one thing that shocks me time and time again when I look at a house, and I don't mean to freak people out, that has 30 offers on it, and I look at the column with did lender contact? And most of the time it's one, maybe two lenders actually reached out to me out of 30. And that's what's astronomical, is I think people think, oh yeah, everybody's doing it, whatever, it's not going to make a difference. Do you know how big of a difference that makes when I actually get to talk to the lender on the other side that sits there and says, hey, I just want you to know that they've given me permission to discuss a few things with you. One is I verified their liquidity. I understand that's a standard operating procedure right now to put in an appraisal waiver. The agent seems very confident that even with a little bit of risk on a shortfall, that they're going to be fine. And I agree. I verified their assets, blah, blah, blah. Here's where we are. I mean, gosh, what a world of difference.
Well, and one step we're doing a little bit extra stuff is we actually send the file, because it's really hard for people looking for houses because there's not very much availability. In the Firemount area, we had some loan officers. There's 158 buyers looking at 17 houses. Mm-hmm. So, I mean, you have that right there. But what our loan officers are doing is taking the next step. They're sending to underwriter to verify all that stuff that you're talking about.
Yeah.
And when they reach out to you to tell you, say, hey, look, this guy's going to close. We have no problems at all with this. The underwriter's already signed off on it. Unless something comes back crazy with the appraisal for whatever reason, that's the only way we're going to have any problems with this at all, or entitled. I mean, those are the two things that we can't go around and move forward until we get the contracts. But as soon as we get that stuff, we try to make sure that we keep you involved in this whole process, so you know that you're not just out there just waiting for something to happen. So,
well, and I think that's important. And it's important to know the infrastructure of your company, to know what's in-house and what's outsourced. And I think there's a lot of these big name companies that I won't sit here and say anything about. But as a listing agent, if I see a pre-approval letter from somebody that I know is just basically an order taker and it's a call center loan, I'm going to question what my experience is going to be. All right, Sandra, good for you, Ashley, for answering your phone. So many listing agents just don't, and it's so frustrating. Sandra, I literally put in my private remarks on my listings, please feel free to reach out. I will answer my phone with a smiley face, because nothing bothers me more than somebody that puts something in all caps. Everything is so inflammatory. And it's like, we liken it to that you're the queen of hearts, says the listing agent. Off with their heads, you poor peasants that have buyers. I mean, that's literally what we're dealing with right now as a buyer's agent. But I know what I'm dealing with my buyer. I know the anxiety that they're going through. I know the really hard decisions that they're having to make at an early stage. The millennial buyer pool is the largest we've ever seen. And these are people that have had to work very, very hard, whether it's with student loan debt, to get to a higher price bracket or earning potential in their jobs because of the rate of appreciation in the home values and not in the compensation. But they're finally here, and they're sitting here and going, I want to be a good steward. And when I'm sitting there and saying, okay, I understand you want to be a good steward, but some of it has to do with the listing agent on the other side, the whole package that we're dealing with. I've told buyers, we have that conversation from jump. I'll let you know when they literally put in the private remarks, the only thing that's important to the seller is price. You know what? Then we need to have a discussion. If this is your dream home, we'll put in our best effort. But if it's not your dream home, then we have to think maybe this isn't the best team to move forward with, and we'll wait for another one. Oh, Chad, yes. And your loan officer should be willing to talk to. So yes, that is something. I mean, it's hard. I think there are a lot of loan officers that want to just hide behind the screen, and they don't want to do the consumer facing stuff. And it is unnerving to just pick up a phone and call, but it's not just calling. It's responding to the offer email that your agent teammate makes on behalf of one of your borrowers. It's then calling on the other side and just saying, hey, I just want to reiterate what I said in the email. If you need anything, I'm here. It's just so important right now to have a great experience. Yes, Patricia, some never respond, and it is horrible. And here's what I'm going to say. It's going to come back to bite everyone, because You know what? It's not a situation of, look, our clients are the ones that are in the driver's seat of making the ultimate decision, but there's a lot that goes into making that decision. And my clients want all of my advisement and advocacy. And if they say, Ashley, do you think this is going to be a reasonable working relationship? Hey guys, I've left 3 messages. The agent's not responding. They're not texting me back. I have very little information. Yes, Anjanette, it is karma. But it's one of those things where then I say, and they go, you know what? I think we're going to pass on making an offer. Because if you say that you can't even have a good working relationship because there's not even open dialogue with the listing agent, either the seller's going to be the same way or the listing agent is just going to be hard to manage the entire time. We don't want to participate. We're already having to pay more than we thought we were going to. Interest rates are higher. We've got to mitigate some of our risk in this process. So let that be a lesson to realtors on this live stream right now, that it does matter how you behave on the listing agent side. And we do, being a proper fiduciary for our sellers, it does mean answering the phone. That doesn't mean you have to do it at 11 o'clock at night, and you don't have to sit there and be tethered to it all the time, but you have to make a conscious effort to disseminate proper information. And that also means talking to the loan officers that are calling you as well on behalf of these buyers. What do you think, Greg?
I agree 100%.
Yeah. So I know, and we need to do a little bit more co-oping on the education between, our affiliate partners and realtors. And we don't always do a good job of teeing you guys up for success either. And when we see shifts in the marketplace, we need to be communicating with you saying, hey, here's what's going on. Just like I had a listing a couple of months ago where I noticed that the majority of them were not contingent on financing, meaning they didn't need that financing period built into that third-party financing addendum because, like you said, all of the information was already verified. Debt to income was comfortable, did the employment verification, verified assets, tax returns, whatever else. They said, you know what, that's one less thing that you have to worry about. And so for me, I was like, hey, this is a trend. This is awesome. And so also empowering my buyers to say, hey guys, this is what we're going to do. We're going to do a little bit of our homework up front and make sure we're teed up for success. It's a new trend. It's not a trend. It's just, if this is something that we can do, it needs to start being more of a standard operating procedure where we can control it that way.
And that just shows you if you have a good loan officer or not. I mean, that's all there is to it. I mean, a good loan officer is going to make sure that they're going to take care of all your needs, the buyer's needs and the listing agent's needs and stuff like that, to make sure everything closes on time and everybody's happy, because nobody really cares what's going on through the process until you get to the closing table. And if something goes late or whatever, and sometimes it's nothing you can do about it because of title, like I said, in the appraisal, but if everything's done correctly and everybody's there and you have a true partner with you the whole time, you shouldn't have any of those problems or any of those hiccups coming through. So,
well, I'm going to give you some good news. We only have 15 minutes left. Right, like,
I'm not sure if y'all noticed, but I'm really, really nervous right now. So that's all I got to say.
No, you've done a great job, Gregg. And, some of it is just, this is what's great about Real Talk is this is more of just having an open dialogue and conversation, allowing people to chime in on the chat and talking about what's important to them right now and giving some perspective. But I do want to talk a little bit of, the water cooler talk and what we're hearing on the realtor side are the things that are happening. Oh, Francie. No, I just got here. Okay, Francie. Well, you still got 15 minutes left and you can go and look at the other stuff. We're going to keep going. But Francie is one of our awesome affiliate members and a proud owner of a moving company. And she's a great realtor affiliate champion. So we love her. So yes, Gregg is offering some impressive knowledge. I think that's fantastic, Gregg. You look at it from all these different angles. There are, the economic infrastructure, oil and gas, and what that's doing to the back end of our economy and rates and bonds. And you talked about a lot of things that I don't even know how to discern. But that's cool because that then expands my mind to go, hey, that's something I haven't heard before or don't hear enough. And I need to do a little bit more research on it. And so I appreciate that. And Jeanette, a good LO has a solid process, provides regular updates, and completes a thorough review of income and assets up front, and is not shy to speak to the people involved. And Jeanette is also a fantastic lender affiliate partner that definitely goes over and beyond for her clients and does a lot for her association. And so we are very blessed on both sides that we do have amazing realtors and we do have amazing lenders and affiliate partners that do advocate. We have to bond together and band together during these times and talk about what it is to be professional, raise that standard operating procedure a little bit more when it's so stressful the way it is. Sherry said, some of the things you're talking about as needing to do for this market should truly become our standard. It's like I read that and I didn't. Raising the standard operating procedure. It's like we're connected or she's my mom or something. And we just think.
You're related to her?
We might be related. I know.
Okay.
Yeah, absolutely. I know. Can you see the face? Maybe not the hair, but it's the face. So one thing I do want to talk about, though, is something that's also happening is, look, investors and landlords are being really demonized right now for a lot of different reasons. But really what's going on is we have a shortage of properties to purchase and we have a shortage of properties for people to rent. So it's happening on both sides, which means we can't demonize people buying properties to make them rentals, because I can tell you right now, you can go and list something in the HEB area and for $1,800, $1,900 a month, you'll have 15 applications in about a matter of 3 hours. It's astronomical what's happening to our rental rates. And so that's a whole nother topic of why it's still good to purchase a home when you're talking about how much the rental rates are increasing as well. And that's obviously something that we need to reframe our conversations about. But I want to talk to you about the investor rates for just a second, because that's also something that we're seeing, what the rate is for an individual home buyer that's actually going to occupy the property versus an investor. It is a little different. What's the delta between the two on average? I know, considering the same credit, prime credit, everything else, what are we looking at? 1.25?
It really depends on your LTV. So it matters how much the investor is going to put down. So what happened about, and I'm probably I think it's about 5 years ago, is where Fannie and Freddie changed the rules and let you start putting 15% down and getting MI. So that opened up the pool for the investor stuff a little bit more. On that kind of rate right there, you're going to probably see it could be up to a point in rate higher. The problem is that how everything's working with the aggregators and with the Fannie and Freddie, they don't want you to be able to have a 7.25, 7.5 rate for that. And I don't understand really the reason why, but they're afraid that they're going to refi out. In an investment property, it's going to be harder for you to do that. But so usually you have to pay a lot more discount on the investment property, the higher LTV. When you start putting 25% down, you start seeing a lot more forgiveness and all that stuff, and your rate comes down quite a bit. But it just really depends on your LTV, on all that stuff, to see where you're going to get and your FICO and all that stuff.
So, I mean, just for me, I probably about 30% of my business in the past, year to 2 years has turned into investor purchases as well. That a lot of it's because of the volatility in the financial market. People still feel a lot more comfortable parking their money into the housing market, even though it's growing at an astronomical rate, but it's still more steady than anywhere else.
Well, just think about it. I mean, just about 18 months ago, you could go around and get an investment property and get a rate at 4.25. I mean, that's great.
And I had some at 3.5 a year and a half ago. Yeah. I mean, that's insane.
But that's usually you're going to be your lower LTVs, very, very high FICOs and all that stuff on those right there. I've been in the business so long where I remember when they started doing loan level pricing adjustments that Fannie and Freddie did. And what that means is everything's risk. If your credit score and your LTV is at 95, if you have a low FICO at 620 and at 95, there's a good chance that you have a higher chance of foreclosure. So because of that, they started doing having higher rates for those people, and that started making a huge adjustment for everybody else. And I just lost my train of thought.
You know what? Here's what's really interesting. I was talking to a couple of investors about this because they're like, Ashley, why are we getting beaten up? And I said, look, here's the deal. Here's the thought process is you're not going to default on your primary residence as quickly as you default on an investment property. And they said, why the heck would I default on my investment property when I can rent that thing out for $500 more tomorrow? It makes no sense whatsoever. And so I think that's the difference. And there is a little bit of an ideological shift, because what we saw in 2007 and 2008 and 2009 was people were baiting because they, like you said, they lost their jobs, the rental market, everything tanked, right? Everything tanked. But right now you're sitting here and going, the rental market's increasing at the same rapid rate as the home appreciation side is, because we don't have enough homes to put renters in. So it's a little bit of a backwards thinking as far as that's concerned.
Yeah, but you have to remember this right here. I mean, you have these people that are just playing with numbers all day long, and they're looking at risk. I mean, you have these risk adjusters. I can't think of their names, but it's the same thing as for your life insurance. You smoke, you overeat, you're going to pay more for your life insurance. The same thing with investment properties. It might be great right now, and you might make $500 or $600. Now, are you going around and putting that money aside when your house sits for 12 months, or are you actually using that money and spending it on something else, or buying more investment properties and creating more risk for yourself? I mean, that's the whole thing about it. I mean, in no offense, these guys that are doing this stuff, they're looking at data from 1971 all the way through right now between the foreclosures. I mean, all the recessions that we've been through. I mean, all that stuff is what they're looking at, and they're looking at the interest rates and stuff, and that's where they're at. So, I mean, I can understand where you're coming from on that part, but on a risk standpoint, that's where it gets a little hairy and stuff like that, because they're not looking at 12 months from now. They're looking from 10 years from now.
Well, and that's what Sherry just said. Actuaries. They
actuaries. Thank you.
Yep. Longer term historical data to make. But again, here's what I'll tell you. It's been a little different the past 2 years, and the roller coaster we've been on. And I'm not saying that you have to abandon all logic and data points to make those decisions. But listen, Greg, I'm talking to you like you have the ear of the people that are deciding whether or not we abuse these poor investors at the same rate that we're doing.
It's just statistical data. So in the 1982s, during the oil, when we had when the oil boom crashed in Texas and stuff, the Fed had to go around and get all this the loans that all the SNL, I mean, the savings loans departments and stuff put aside. They went around and had to sell them in blocks. And they were selling, 100 houses at a time, even in the state of Texas, because if they sold them all at once, they would go around and everybody's house would depreciate so much. So that's where they're looking at all this stuff. Now, is there a chance of this happening again? You're probably right. There's not. I mean, there's probably a very, very slim chance of the economy going crashing, us not going around and getting where it's at, and we're going to go through the same thing that we did before. I mean, there has to be a lot of bad things would have to happen for that to happen.
Can I ask you one thing? And just popped into my mind, and some might think I'm nuts. By the way, Rehash Design Real Estate Group, yes, it is at least a point higher for investors right now. And I've been working with investors consistently for the past 6 months while rates are increasing and comparing both. So that's at least FYI, depending on like what Gregg was saying, what they're putting down, what their FICO score looks like, all of those other things. Has there ever been discussion of regional consideration?
No.
Well, that's crap. I'm just going to throw it out there right now. Okay. We got 5 minutes left, so let's make it a little exciting. I don't understand that. We've been talking about our economy. We're talking about how we can hedge our bets in Texas and do all this other stuff. But from a national level, we're going to put everybody holistically in the same box. When if we were a country, the state of Texas, we'd be the 9th strongest economy in the world. And we don't have preferential treatment for regional rates. Why do you think that is?
You do. Okay. So rephrase that. So on the servicing side of it, of how long the loan's going to stay in, and all that stuff, then we do have better rates on that from California. California loans are a lot bigger, so they go around and they have less yields in them because they can make as much money as they do in the state of Texas. I believe our average loan amount for most of our people in Texas right now, our average loan amount is around $278 for conventional and $260 for the government stuff, and that's including VA and FHA. We do get a little improvement right there, but nothing to go around and just like.
That's not regional consideration. That's pricing. That's price of the average loan consideration.
Well, this is the thing about it. It's the same thing with insurance, right? I mean, they go around and they don't want to go around and get too many people in one area. In the same concept is where that's at right there. I understand where you're coming from, but I don't agree with that, because you can't just look at just one little central place, because if you go around and have a bunch of foreclosures in Arizona and stuff like that, that's going to affect everything across, because your coupons that you're going around and selling all your loans into, they're pulling them all from all different states in there. And then you just have to look at your servicing and how long is that servicing will last. So, the average home buyer stays in their house for 7 years. So that's my thing.
Hey, I appreciate you. My dogs are even going crazy here in the background. Apparently they've decided to come out of their kennels. But I think that's the problem. And from the financial industry side and hedging your bets and historical data and the economist side, you want to look at it from a very large surface level approach and how you're looking at all the data points. But then you're talking about here as far as how our marketplace, which is that we've been talking about that. This isn't you under fire, by the way.
But let's just say this right now. Let's say that somehow Elon Musk goes around and figure out this great way where his battery life's going to last, 1,000 to 2,000 miles, and it takes 15 minutes to charge. Mm-hmm. Well, and his car's going to be $10,000 than if you go buy a gas vehicle. Then guess what? The state of Texas, don't get me wrong, a lot of the investors that are in oil and stuff, they have reinvested into real estate, different companies and stuff like that to help us quite a bit. So we shouldn't have that same kind of those things. But if something like that does happen, it's going to crash our economy just like that, especially in the state of Texas. So if you look at it that right there, if we're dependent of oil and all that stuff and all these great things that our state's doing, that's how you have to look at it. You just can't look at it just saying, okay, well, we're awesome. Everybody's moving here because we're awesome.
Well,
I
Greg,
just can't see it that way.
here's what I will say with 1 minute left, because we like to be timely. This is where I'm a pain in the butt, and I'm going to
Oh gosh.
agree to disagree with you. Even like Chad said, there she is when I started popping off. That's that's something that it's I get it. And I get it that when you're talking about the financial backing and those industries and everything else, there is a much different vantage point. But I work with a lot of investors. I have a lot of people that are renting instead of purchasing, or just trying to find transitional housing in the midst of trying to purchase and things of that nature. I would just say that, you know what? God bless Texas. I'm glad to live here in these times. And I do think there should be better financial consideration when you're talking about the health of our economy and our housing market versus some of these other areas like we've been talking about. So maybe this real talk will spur some different consideration because we have that much perceived power here.
I mean, the only way you can really do that is if you get your $100 billion from your savings account, we go around and create our own little security and stuff like that. Then we can go around and you can get your concession that you want. Until then, I'm pretty sure that's going to be a hard sell. So, but if you want to pull that kind of money out, then we can get you low rates. There's all sorts of kind of stuff I can do for you then.
Well, if I have $100 billion, I'm paying cash for these properties right now and cash flowing them out the wazoo. So, it was a great end to a great conversation. Greg, you are an extraordinary individual with a lot of knowledge beyond just the loan industry. And I think that's what's so important, is to have industry partners, great companies like AmCap, that is Texas-based, proud to be. And make sure that you guys continue to align yourself with phenomenal lender partners, because it's tough for all buyers right now. But you know what? We need to continue to advocate. And we can do that by creating these relationships. So if you have any other questions for Greg, you can always put them in the chat. But Greg, I'm going to let you give one statement. It doesn't have to be anything that we've talked about tonight, but one trailing thought for our watchers today.
Just tell your buyers to be patient. If they find a house that they really, really love, that they can afford and makes sense for their situation and stuff, get it. And just tell them in a couple of years, hopefully, there's no reason why it wouldn't be, where they can actually get with their loan officers and refi and get them a lower rate if that's what they're really worried about. Other than that, rates are still low compared to historically. I know you don't like historically, but historically they're still low, and you still get some great deals out there if you're looking.
You know what? I agree with you, Greg. I'm going to put one more exclamation point. I know we're running a couple minutes over, but Patricia just put, what is the best way to help our VA buyers? Patricia, here's what I'm going to tell you. I have a listing that had a VA buyer that we accepted, and then it was contingent on the sale of their home that had a VA buyer. And I had an amazing seller that thought that was a fantastic thing that happened. And so going back to what we were talking about, you need to make sure that you're aligned even with the listing agent. Have that dialogue and that conversation. And if that listing agent won't engage you and they won't have any conversation, then unfortunately, they're probably going to demonize an FHA loan, a VA loan, something like that, even though an appraisal waiver is only a freaking piece of paper and people can default on that piece of paper as well. I think it's just having conversations. And you know what? There is a little bit of a shift with the increased interest rates, which has been a glad recalibration just a little bit in the thought process. So hopefully it gets a little bit better for us all. And Sandra, I love you chiming in on refinancing and everything else. That will probably be another conversation for Greg or one of his amazing counterparts. But you can still chime in the chat and we'll respond where we can. Greg, you can do the same thing, even you don't love social media. You can chime in there and answer those. But we appreciate you taking the time.
You're welcome. And just let you say this real fast. On your refi rates and what you're talking about, they're usually exactly the same as a purchase rates at this time right now. The past 2 years, when there's so many loans that everybody was doing, they had a little adjustment for refinance, but other than that, there's none at all.
Yeah.
When you're trying to sell.
Well, great. Well, keep on reaching out to those listing agents, guys. And if they don't answer, let your buyers know that unfortunately it might be a wasted opportunity, but you can still try. Set proper expectations. And like Gregg said, be patient and let's band together. Let's do better from the lending industry, from the realtor industry, and